right, hopefully everybody can see me. Welcome this afternoon. Today we are going to be talking about Charitable Planning 101. So we get everything aligned and organized. We may have a few more people popping in as we get started here, but in the interest of time and to respect everybody's schedules, I want to get us going. Okay, obviously, if you want to go back and watch this in the future, didn't catch everything, I am planning to go over a lot of material. So if you don't catch everything the first time, you are welcome to go back and watch it again after the fact. It will be redistributed to everybody that registers, and it will also be posted on our website and YouTube channel for future viewing. So, all right, with that, welcome to Charitable Planning 101. During today's topic, we're going to explore how to align your philanthropic goals with smart financial strategies. And obviously, as we're approaching the end of the year, I was just playing some Christmas music, hard to believe. But as we approach the end of the year, this is a great time to think about your charitable giving and its impact, not just for this year, but also for future years as well. All right, but first, and again, important disclosure, this presentation is for educational purposes only. I'm not providing legal or tax advice, so please consult a qualified attorney or tax professional regarding your specific situation. My role is to help coordinate your financial plan with your estate and legacy goals, but I cannot provide tax or legal advice. And some of the strategies that we will be talking about today will probably require involvement with one of those two folks if you're going to be implementing them. So, all right, so consult a proper professional for your situation. All right, so what are we going to be talking about today? Just a brief section on why it matters, why doing charitable planning matters. We're going to talk about the tax and financial benefits of charitable giving. We're going to be talking extensively about a number of different giving strategies. We are going to talk about some of the pitfalls that happen around charitable planning, a few resources, and open it up to questions and answers at the end. Okay, so that's where we're headed today. Okay, so first, why charitable planning matters. Well, first and foremost, charitable giving is a way for individuals and organizations to help to strengthen their community and reflects their personal values. There are certain things that we pay the government to do through our tax dollars, and there are some things that we don't have the government do. It's everything in the middle that benefits society, that where either individuals or organizations have to step in and provide that, whether that's a food pantry, sheltering the homeless, providing assistance for seniors or veterans or those types of things. This is where charities and philanthropic organizations come into play. Doing charitable giving provides opportunities for individuals to scratch an itch, if you will, to provide emotional satisfaction, but it also has financial advantages. As a society, as a country, we provide incentives, financial and oftentimes tax incentives, to encourage people and organizations to do charitable giving and philanthropic activity. So some of the things around charitable planning here is if you feel strongly about a particular issue, particular organization, a particular societal problem, then being able to give of your resources, your money, and sometimes your time helps to allow you to align your values with your financial assets. Okay, so it's important, especially as we start to talk about higher dollar values, that you spend some time thinking about how you align your giving with your personal values, what's important to you, putting that down on paper and providing a written plan. If you have family members or even friends that have a shared purpose, sometimes it's helpful to have groups that get together or join organizations for that shared purpose. Okay, so pulling your values and your financial resources along with your community that you're a part of. Okay, so charitable planning matters. It's a important piece of how we function as a society. And again, the charities fill in the voids, fill in the gaps between what we do as individuals and what the government provides to us. All right, so let's talk about some of the tax and financial benefits of charitable giving. Okay, so first and foremost, most people are most familiar with cash contributions to public charities. So this is you writing a check to a church for maybe tithing, maybe giving to the, dropping some coins in the bucket in or out of the store going in. This is basically providing cash, greenbacks, writing a check or sending an electronic funds transfer, some form of direct donation of cash. Not everybody is aware of the limitations on your deductions. So oftentimes people are giving cash so that they can write it off. Okay, they can get a tax deduction associated with that donation. But there are some limitations on that amount. So what exactly is that? So currently, under current tax law, cash contributions are deductible up to a maximum of 60% of your adjusted gross income. So on the slide here, I have an example. So if you have a $100,000 adjusted gross income for your tax return, then that means that you could donate and deduct up to $60,000 for that year. Okay, 60% of your AGI. So what happens if you say, for example, donated $100,000, but you only had $100,000 of AGI? Well, the remaining $40,000 of that donation would be carried over to be deducted the following year, but again, subject to those AGI restrictions. Okay, so that's for cash contributions. So non-cash contributions or non-cash donations, such as property or securities or art or pretty much anything else, the limits vary by the asset type and the recipient organization, the type of organization you're donating to. But the general thresholds are you're limited to 30% of your adjusted gross income for gifts to certain private foundations, veterans organizations, or fraternal societies such as the Masons or the Elks or the Lions or those types of things. Okay. The other limitation would be any of those private foundations that are not specified. The limit is 20%. Okay, so if instead of $100,000 of cash, you donated $100,000 of securities, then instead of being able to deduct $60,000, you would only be able to deduct $20,000, and that is $20,000 of its current fair market value, however that is determined. Okay, so the last bullet there on the bottom is if that contribution exceeds those annual limits, then you can carry forward the excess, the amount you were not able to deduct, onto the following tax year's tax return for up to as much as 5 years. So if you are planning on making significant charitable donations, it's important to understand those income tax limitations. That does not prevent you from making that donation, okay? You are welcome to give away as much as you want. What it does limit you is being able to take a tax deduction for the donation. Okay, so let's make sure that we're clear about that. Okay. Now, what's changed for this year and going forward? Well, there were a number of changes that affect charities in the One Big Beautiful Bill Act that President Trump signed earlier this year. So the first one that is maybe a little bit exciting to those folks that do not itemize but are charitably inclined. If you do not itemize, you take a standard deduction. You now have the ability to donate up to $1,000 if you are a single filer, and up to $2,000 as a married filing joint filer. And these are what would be considered above the line donations. So previously, you had, if you were going to take a deduction for a charitable donation, that had to be done on your Schedule A, which is used for itemizing deductions. Well, if you didn't have enough itemized deductions, well, then you just did the standard deduction. And so you effectively lost the benefit, the tax deduction benefit of any itemized charitable donations. So the OBBBA changed that and gave everybody the ability to get some charitable donation deductions above the line without having to itemize. So now you can either take $1,000 or $2,000 if you're married of charitable donations and deduct that and still take the standard deduction. So that's a welcome change to this year. Okay. Now, in addition, so you got standard deductions of $15,750 for single and $31,500 for those that are filing jointly. However, so for those that do itemize, there is now, because they added this above the line deduction, there is now a AGI floor when you do itemize. And so what does that look like? Okay. What that looks like is there is a 0.5% AGI floor for deductions, and this primarily affects higher income earners because the higher your income, thus the higher the floor. So if you see in the example that I have on the slide here, if you give a $10,000 cash gift and you have a $200,000 income, well, then that sets your deduction floor at $1,000. Okay, so that would mean that of that $10,000 gift, only $9,000 of it would be deductible on the Schedule A. Okay, if your income is higher, say for example $400,000, well then your floor is now $2,000, and the deductible gift is now only $8,000. Okay, so there's it's what it's doing here is I don't want to say it's penalizing charitable donations, but it is lowering the tax benefits for those charitable donations for those higher income earners. Okay, so it's not a free lunch in terms of you get to donate as much as you want and get to deduct it all anymore. Also, we are still limited to those AGI percentages in terms of the amount that you can deduct, either the 60%, 30%, or 20%. All right. So a couple of changes related to the new tax bill that was just passed. Okay, so sorry about that. I need to figure out how to operate my slides a little better. Excuse me. Okay, also related to giving, you have a state, and in this you'll understand how this affects things a little bit later, but you have some changes to the estate and gift tax regime. Each year, each individual has the ability now in 2025, and this gets indexed going forward, it has the opportunity to give up to $19,000 per recipient. Okay, so I can pick as many people that I want in a given year and give them up to $19,000 without any gift or estate tax consequences. So that would mean that a married couple can give up to $38,000 per individual recipient, $19,000 each, $38,000 combined to each recipient. So that could be your kids, grandkids, neighbors, high school sweethearts, whatever. Okay, so that is a way of passing on wealth to the next generation or others without having any gift or estate tax consequences. And so you don't have to file any sort of gift or estate tax return. The other thing that the OBBBA law put in, kind of, I don't want to say set in stone, but kind of made permanent, is the lifetime estate and gift tax exemptions. So now going forward, that is $13.99 million per individual, so almost $14 million as a single, or almost $28 million as a married couple. So you can either give or bequest up to those thresholds without having any gift or estate tax consequences. So now gift and estate gifts that are above the 19,000 or 38,000 threshold, those start eating into that exemption amount, that 14 million or 28 million. So what that effectively means is that an individual can give away or bequest up to up to 14 or 28 million dollars either during their lifetime or upon their death without any estate tax consequences. Now, what happens when they're above that? Okay, so if I'm single and I have a net estate of $20 million and I haven't given anything away, I pass away and I leave my estate to my dog. Well, the dog gets to exclude 14 million of it, but the dog's then going to have to pay estate taxes on the 6 million that the dog received. So, and that tax rate is 40%. Okay, so 40% on the amounts above the exemption level. Not too many people that's gonna affect, but when you fall into that category, it's a big number. Okay, so one other thing to note, if you make gifts above the annual gift exclusion of 19,000 or 38, all right, then you have to start counting it toward that lifetime exclusion amount, that lifetime exemption amount, and you're required to file a Form 709. And that basically means that you get to track those gifts for the rest of your life, because the IRS has to determine how much of an exemption you have left once you die. So just kind of keep that in mind as you're considering. It's not a huge deal. It's just another form that gets added to your tax return, but that will be a permanent addition to your tax return moving forward. All right. So now that we've covered that, let's talk about some of the charitable giving strategies that people can take advantage of either in the current year or over the course of their life. So we're going to talk about direct gifts, bargain sales, bequests at death, donor-advised funds, community foundations, private foundations, two different charitable trusts, a charitable remainder trust and a charitable lead trust, a wealth replacement trust, and the infamous qualified charitable distribution. Okay, so those are the strategies we're going to talk about. All right, first and again, most straightforward is a direct gift. This is you write a check You give somebody some cash. So what is the benefit? The benefit, it's simple, it's straightforward, and it's easy to track. The charities can receive the cash, the gift, and put them to work immediately. Now, if we're talking about direct gifts, it doesn't necessarily have to be just cash. It could be, again, securities, could be gold, could be personal possessions that are valuable or can be put to work. I know there's a lot of organizations that now take old cars to repurpose them. So there's a lot of other things that you can donate. So for things that do not have a readily available market value, you may need to hire a professional to appraise it in order to protect yourself from the tax deduction, especially if you are trying to stretch the value a little bit. It's important to not get sideways with the IRS when you're claiming the value of a particular donation. You're also going to want to keep the receipts or bank records to validate that particular deduction that you're claiming with the IRS. Okay. Now, the notes on the bottom there are basis. Okay, that is basically the original cost of the thing that you are donating. Follows the gifted item. Okay, so if, for example, you gift appreciated stock to your kid, okay, well, your kid can turn around and sell that appreciated property, but they are now going to have the original basis and are going to pay income tax. They're going to pay capital gains tax on the sale of that appreciated stock. Okay, so always think about the basis following the gift. There are some exceptions, but generally speaking, that's the rule. Now, charities, generally speaking, 501c3 or other types of nonprofits, are exempt from both income and capital gains tax. And so this is one of the reasons why it is beneficial when you are developing a gifting strategy to consider gifting those things that are highly appreciated, such as stock, such as real estate, such as appreciated art or other types of collectibles where there is a significant amount of appreciation. The charity, when they go to sell the asset and kind of turn it into a cash to be productive, they're going to be exempt from tax, both income tax as well as capital gains. So you, as the donor, get to deduct the full fair market value of the asset, okay, less your basis, okay. So that the value of your donation is the fair market value, what it's worth today, less what you paid for it, okay. And the charity gets to take the whole thing, sell it, and put the entire value of cash to work for the benefit of the organization. So that's the benefit of direct gifts. Okay. Always consider talking to a tax professional when you're looking at making a significant tax deductible donation. All right, another strategy that's sort of related would be considering making a bargain sale. So a bargain sale occurs when you sell an asset to a charity for less than its fair market value. So the excess of the sale price, the excess of the value over the sale price, that's what's considered the donation. So let's say you donated an appreciated property worth $500,000, but you only charged the charity $200,000. Okay, so the difference, the $500,000 minus $200,000, is the excess over the sale price. That is the value of the donation. So you don't get to donate. You don't get to write off a full $500,000. You get to donate what you gave less what you received. Okay. So there's some different reasons for doing this. it really depends upon if you're doing this related to trying to dispose of an asset. You still need some of the cash from it, and you could benefit from a large tax deduction related to a charity. Sometimes the tax deduction helps to pay for or offset the loss in value of what you're getting. Okay, so again, this is where having a tax professional crunch the numbers and help you see whether or not it'd be worth it is beneficial. Okay. All right. Charitable bequests at death. Generally, these are easy to set up either through your will or through a trust or a beneficiary designation on any specific accounts like retirement accounts or life insurance proceeds. Doing charitable bequests at death are good choice for retirement funds because the money goes straight to the beneficiary. Okay. And again, specifically for retirement accounts, if the money goes directly to a charity, then the charity doesn't pay income taxes on the money that they receive. Whereas if you left it to your grandson, who then needed to go buy a Lamborghini, they would have to withdraw the money, pay taxes on it, and they would have that tax bill that they would have to contend with, versus the charity doesn't. Also, remember, on appreciated assets, when you pass away and you leave those assets, the individual that receives non-retirement account assets gets a step up in basis. Okay, so the step up in basis generally steps up to the fair market value at death. So this might be a property or a house or something. You leave it to the grandkid, and they receive that inheritance with a stepped up basis. They can turn around and they can donate it or sell it. Okay. But the same thing holds true for charities. So again, the reason why using retirement funds to bequest to charities, if you're so inclined, is because the charity doesn't pay income tax when a human otherwise would. Human or a trust otherwise would. Okay. So charitable bequests at death are something that you can consider. So oftentimes this is alma maters. This might be the church. This might be other organizations that you have been involved with during your lifetime. Okay, now we get a little bit more complicated. The next one on the list is the donor advised fund, the DAF, donor advised fund. What a donor advised fund is a pooled group of assets. Okay, a donor is you can kind of think about it as a mutual fund structured to make charitable bequests, not immediately, but at your direction in the future. So a donor advised fund gives the donor, that would be you, the right to advise the charity about the grants made from the fund. Okay. DAFs can be established during your lifetime or at your death by making a bequest in your will or trust, or naming the fund the beneficiary of retirement accounts, life insurance, or annuities. You can name a family member or members to advise the fund after your death, and DAFs are generally easy to set up and usually require some amount of a minimum donation, as little as maybe $5,000. And we have a donor advised fund that we use. So if folks are so charitably inclined, they can donate to the DAF. That allows you to take the tax deduction in the current year, even if you want to spread out the donations over time. So maybe, for example, in your estate planning, you have set aside a significant chunk of money that you want to go to a particular charity or foundation or something of that nature, but you just don't want them to have all the money all at once. So you can make that donation in the current year, take the full tax deduction, and then you can meter out the money over the next few years or so, or whatever the time horizon is. There is no current minimum amount required by the government in terms of how much has to be distributed at a given time or in a given year, which differs a little bit from the structure of foundations, which we will talk about shortly. So really this strategy is you can donate and deduct now. You can deduct now and donate later. Okay? And sometimes people don't even know that the organizations that they want to support, they just know they've got this asset. Maybe they're getting, they just had a significant payout from, employer stock or something like that, and they know they want some of that to go to a good work, and so they'll use that asset to fund these donor advised funds. That also has the benefit, if you have an appreciated stock like employer stock that you have, and you don't want to sell it and incur the tax liability, and you're also concerned about the risk level of that particular stock, what you can do is you can take that stock and donate it into the donor advised fund, and then because there's no tax consequences inside it, you can actually have it diversified. You can spread it so you don't have the risk of a single stock losing all of its value all at once. Okay, and once the funds are in the donor advised fund, making those directions in terms of the charitable giving is relatively easy. It's relatively easy and straightforward. Usually there's a website where you can make the request and the funds go out relatively quickly. So donor advised funds, a very cool way of giving. Okay, so now we're kind of getting into some things that are for a little bit more of the wealthy and those that have the means to do this. So, a community foundation. So this is a nonprofit charity that's established to meet the needs of its local community. So think about the food bank, or other types of community. There's a Sacramento Community Foundation. There's a each city kind of seems to have their own community foundation. Basically, donations are held in a collection of individual funds that can be named after the donor or donor's family, right? So think about naming privileges on buildings, right? And also, when you make a donation to a community foundation, you can put restrictions on how those funds are to be used, right? The managers don't generally like that. They like to have the freedom to use the money and what they want. But if you're making a sizable donation, you have the right to put some restrictions on that, and the community foundation can determine whether or not they're willing to accept those conditions or not. So community foundations, and going hand in hand with community foundation is the private foundation. So private foundations are generally set up by a wealthy individual or family, or sometimes they're formed by the corporation of a wealthy individual or family for the purpose of achieving some social, environmental, or public good that is important to that particular individual or family. They can serve as a great vehicle for implementing that donor's charitable vision. So think about Bill Gates. He's got the Bill and Melinda Gates Foundation, that has a number of different purposes, but one of them primarily to ending world hunger. One of the principal advantages of the private foundation is the donor's ability to control how those donations are invested and used. Okay. However, one of the downsides is because of the level of control, private foundations are generally subject to more regulation than a public charity. And that also goes for the donations that go into the private foundation. They're more controlled and restricted in terms of their deductibility, primarily because they've been abused in the past as a kind of a tax loophole. So, but there's still a great way to make sizable donations for a cause that is near and dear to your heart. The general recommendation in terms of the dollar figure for establishing one of these is, I mean, they can be set up with as little as a few $100,000. Generally, you're probably talking about making donations starting it with north of $500,000 to $1 million at a minimum, and that's primarily because of the administrative burden that comes with running these things. So they're not for you're generally not starting them with a few $1,000s. They're for serious serious charitable activities. All right, and so by the way, again, this is where the donor advised fund really comes into play. They are very flexible in being able to use the funds to support specific objectives. You just don't have quite the same control over the money and how it's used and managed as you do in a private foundation. So there's trade-offs there. Okay, so now we're talking about some charitable trusts. And so the next two, which is the charitable remainder and the charitable lead trust, both of these are considered estate planning tools primarily that have a charitable angle to them. So what are these things? So first is a charitable remainder trust. This is a special trust for you, your spouse, your family that provides income payments to you for either a term of years or for your life. So unlike the direct gift to charity, the charity's receipt of the donation is deferred until the end of the term. So how do these things work? So you take an appreciated asset. Let's just say maybe it's an appreciated stock. You've got some original Apple stock. Rather than selling that stock, paying the taxes, and then living on the income, what you might do is you take that appreciated stock, you create a charitable remainder trust, you donate that stock into that charitable remainder trust, which is now able to liquidate and sell it without tax consequences. And in turn, what happens is that trust pays you the income for maybe the rest of your life or a period of time. And that at your death or the end of the trust, usually it's at your death, but oftentimes they will have a specific time period. But at the end of the trust, that asset, let's say that appreciated stock, is then transferred to the charity to sell and dispose of or do whatever they want with. Okay, so that is a method for turning what would otherwise be a tax bomb, a large tax bill, into a donation that also provides an income stream to you. Okay, and this is a way of managing your taxable estate. So we're getting back to those estate tax exemptions, right? The 14 or the 28 million. So if your estate is expected to be over that, then using one of these trusts would be a way of taking assets out of your current estate, donating it, but getting a source of income, and then the charity gets the asset at the end. Okay, and so that's removing it out of your estate, but still providing you a benefit to that asset. Okay, again, often we're using highly appreciated assets such as business interests and appreciated stock. On a similar note, a charitable gift annuity, if you've heard that term, it is similar to a charitable remainder trust. The only difference is that instead the charity sets up the annuity. So you make the gift, and the charity controls the annuity and the payout of it versus you as the donor managing the trust. Pretty much every significant charity that I know of either has available or they have a charitable gift annuity program in place if we're looking at making donations to, say, fund retirement or some other sort of a cash flow situation. All right, also in connection with that is a charitable lead trust. This is a little bit the reverse of a charitable remainder trust. So in the CRT, the charity gets the asset at the end. With a charitable lead trust, it's the opposite. During the donation period, the charity gets the income stream, and at the end of the trust, the asset goes to the family. So this is another way, it's kind of an estate freeze type of a situation. Oftentimes, this might be for family homes, second homes, cabins, those types of things, where the family wants to retain the interest for future generations, but they want to benefit a charity currently, or they don't necessarily need the current income of the asset, so that donation can happen during their lifetime, and then upon their death, the asset reverts back to their heirs. Okay. Now, one thing about these, though, is unlike other charitable gifts, that the charitable income tax deduction is only available if the donor is recognizing that income, that taxable income, annually. Okay, so there's the charity. The charity is able to get that income, but it has to be recognized annually. It cannot be like a lump sum at the end. Okay, there's a time frame of it that has to be recognized. All right, so those are two trusts: charitable remainder and charitable lead trust. There are many other types of charitable trusts, but those are the two primary ones. The next one on this list is the wealth replacement trust, or this often goes hand in hand with a ILIT, an irrevocable life insurance trust. Effectively, what these trusts are for is it's for pairing a charitable gift with a wealth replacement trust that allows you to make a substantial gift and still leave the inheritance to your heirs. So, for example, if you say, I'm going to donate my $1 million house to a charity so that they can turn it into a museum, but I want to make sure that my family gets the value of that asset upon my death. And this is where creating an ILIT, an irrevocable life insurance trust, comes into play. So you make a donation, okay, and as part of the structure, you create this ILIT trust that now has a life insurance policy inside it, and upon your death, that life insurance policy pays out a death benefit equivalent to the amount that was donated. So upon your death, the charity gets the value of the house, and your family gets the value of the life insurance policy death benefit, which effectively equals the value that you gave away. Okay, so and oftentimes the tax deduction, the tax benefit of this helps to pay for it, right? So if you know you've got a 40% estate tax bomb coming on the back end, maybe you're able to structure this so that it pays for the life insurance, and now your kids get, that $1 million life insurance check tax-free. Okay, so that is the wealth replacement trusts. All right. So lastly on our list is I want to talk about qualified charitable distributions, or QCDs. Many of you are probably aware that at a certain age you are required to take a required minimum distribution. Okay, so currently, if you are if you were born 1959 and earlier, then your required minimum distributions start at age 73. For those that are born 1960 and after, your required minimum distributions are going to start at age 75 and that was for those 2033 and after. Okay, so what is a qualified charitable distribution? That is where you take funds directly from your retirement account. Think about an IRA, 401k, 403b, okay, in which you have a required minimum distribution. You take the funds from the IRA and it goes directly to a charity. Okay, so what is the benefit of that? So the benefit is that the charity receives the money directly, okay, and it does not count as taxable income to you in the year in which you make that donation. Okay, and so this is especially important for those where you have a required minimum distribution. It is both able to satisfy your RMD, also getting the money to the charity that you wanted to donate to anyways, and also not counting as taxable income to you. So it's sort of like a triple whammy benefit of satisfying your RMD, charitable donation, and not having income. Now, one thing that does trip people up a little bit is if you do a QCD, you do not get to deduct the donation as well. So that's sort of double dipping is not allowed, right? You don't claim the income, but you also don't get to claim it as a deduction. Now, one point to note, that first bullet point is that originally RMDs started at age 70 and a half, and that got pushed up with the Secure Acts. However, you can still make QCDs starting at age 70 and a half. And the code, the IRS code, allows you to do a QCD up to $108,000 from your IRA this year. And again, at 70 and a half, you don't have an RMD, but you can still do a QCD. So that's a nice benefit that they left in place for those that want to use that tool. All right, so what are some of the common pitfalls to avoid? Lack of documentation, so not keeping receipts or acknowledgement letters. So if you make a donation, make sure you get a letter. By the way, I don't know if you recognize the icon here, but that's that old game Pitfall. So anyway, keep your receipts and letters to the charity. Any gift over $250 in cash or non-cash donations, you want to have a record for. Make sure that you understand your deduction rules, right? I talked about the 60%, 30%, and 20% threshold. So make sure you know where you stand in terms of your income, your AGI limits, and how much you are planning to donate. Poor timing is one thing. Waiting to the last minute to make this happen sometimes can trip you up, especially if you're trying to make donations to a DAF that is not established yet. So if you're thinking about making a DAF contribution and want to get that account set up, I would start moving on that now. Not looking at strategic tools like I said about DAFs or QCDs. Those are things that are good tools to use. Having a plan for your giving, right? It's okay to do random giving, but it's also more powerful if you have a plan that goes in tandem with that giving. Knowing your estate and gift tax impact, right, and what you're going to be planning on leaving, how you want that to be put to work towards your charitable intentions, and then overestimating your tax benefits. So I always say, don't let the tax tail wag the dog. If you're only donating for charitable if you're only donating to charities to take a tax deduction, you're probably missing the boat a little bit. So, tax savings is great. We all want to save on taxes, and we don't want to pay more than we have to. But again, don't let the tax tail wag the dog. A couple of resources here for you. So IRS has a charitable contributions guide. You can just go to the IRS website and look up or type in charitable contributions. There is the National Association of Charitable Gift Planners. If you are interested in that space. There is a state planning council. There's local chapters that provide webinars and have guides on this stuff all the time. Lawyers love to talk about setting up trusts and those types of things because I think it's a little bit more exciting than doing just the standard wills and trust type stuff. So, and if you are in that category of wanting to consider establishing a foundation, then the Council on Foundations is a good one for helping your family to think through philanthropy and legacy planning. So a couple of good resources. All right, so that concludes the material that I was planning on presenting. Are there any questions that anybody has regarding any of these charitable strategies? I'll open it up for a minute or so. All right, does not seem like there's any questions at this point. But obviously, if there is, feel free to reach out to me directly, and I can answer your questions about any of these strategies that we discussed. Bear with me just a second. All right. So now what's coming up next? Our next session, last session for the year, is going to be our monthly market update on Wednesday, December 10th at 11 a.m. So look for the invitation on that. This is the last session in our Back to School series for the year. So there will be more webinars coming up in 2026. I already sent out some ideas. So if you have an idea that you would like me to present on, either myself or I can look to my wide array of partners that can come in and present various topics. Let me know what you're interested in learning, and I will do my best to put one together on that topic. All right, so with that is all I have for the day. I thank you very much for attending or watching. Charitable planning, it's about making a difference and being smart financially. I hope to be there to help you start doing that planning if you're so inclined. So please reach out if you need any specific guidance regarding this particular topic. So with that, I will let everybody go and enjoy the rest of their day. Have a wonderful Thanksgiving and a happy holiday to you and everybody in your family and life. All right. Take care, everybody.